Okay, so I'm gonna go ahead and make a video on essentially everything you just told me. I'm gonna go ahead and show you an example of how to use order block liquidity, internal structure, swing structure. There's different levels to market structure. It's not just swing highs and swing lows, etc. There's more to it. So I'm gonna break it down to you. I'm gonna incorporate some of my own strategy or like the use of different concepts. Hopefully you understand them. But at the same time, the reason why I want to incorporate some of my concepts into everything I just read is because it'll simplify your trading, right? So obviously you were talking about breakup structure, you're talking about order blocks, right? Now, if that's the case, that's fine. When it comes to order blocks, when price retraces back into an order block, when price goes to an order block the first time, that's usually the best time to focus on the trade, because that piece of information, when price touches it, that's going to dictate if you take the trade or not, right? So usually the first and second time is the best time to monitor. Anything more than 3, 4, 5 times, that's considered, in my opinion, a weak order block. In that case, it would no longer be valid. I wouldn't even enter the trade if it was there for 3, 4, 5 times, especially because when it comes to like fair value gaps and order blocks, you want to see an immediate reaction, but not only an immediate reaction, you want to see some displacement, right? So displacement would look something like this, like these big candles after a big move down. Even right here, we could see price goes up, right, and then it goes back down. You see an impulsive candle or displacement, right? And in that case, this would actually answer your question. This entire circle here, I'm going to use this for the video just because I just found it and it actually would answer your questions. But anyways, looking at the chart, so the thing with order blocks is that they're not very textbook, meaning like in the market, or no, I should say, looking for a textbook order block in the market is very difficult because the market's not always going to be textbook, right? There's going to be times where the trade is perfect, picture perfect, but there's going to be a lot of times where the market is also not picture perfect, right? So you have to be able to adapt to that. And so order blocks are nice, when price retraces into them and it taps 1 or 2 times, that's usually a good time to take the trade. Anything more, reconsider even entering the trade. Usually not taking a trade is better than a bad trade, or missing an entry is better than a bad entry. So let me see what else you talked about. I'm trying to see what else you're talking about, because I don't exactly understand when I should enter from the confirmation for me, which is when price closes beyond the order block and doesn't make a rejection. So that's also important. So the order block you choose is just as important as trading an order block, right? So I'm going to say this 2 times just because I want to make it clear. The best order block to trade is the one that forms after, or that forms before a fair value gap. So when you identify a fair value gap and there's an order block right below it or right above it, that is the best one to trade, okay? So for example, the reason why I like this one is because you can see right here that price has this order block that's formed, and that you have an immediate displacement candle right below it, leaving a fair value gap, right? You see this bearish fair value gap and then the order block, right? So I like this one a lot. You could even look at this one, for example. You can see that there's a order block right here, and then there's also a fair value gap that was left right here, a small one, right? And price, taps it a few times, and then shoots up, right? So this one's good. This one's good. I mean, this one is also just as good as well. But I want to be specific, or I want to reword the word order block, because I personally don't like the word order block. I prefer to using the 2 words supply and demand. Supply is simply going to be your red box, or demand is simply going to obviously be your green box, right? So that's personally how I trade it, but if you want to call it an order block, call it a bearish and bullish order block. That's entirely preference. Remember, a order block is essentially when price is going in one direction, right? The opposite color candle before the move up, or in this case the move up. So this red candle right here would be your order block, this candle right here, and then obviously you extend it to the right, waiting for price to come down to it, which you can see right here, right? And then it goes back up, right? So that would be your bullish order block. Over here you have a bearish order block. So that's just, by the way, I'm just breaking down some of the basics before I actually dive into how to break down this trade. Let me see, what else did you say? I want to make sure I get everything that you're talking about, or that you're asking, just so I don't have to make another video. How to enter when your setup doesn't form. For me, it's when there's no clear order block. Okay, so that's also a good thing. A good trader is not going to rely simply on a fair value gap or an order block. You have to be able to adapt to what the market's giving you, right? So an order block is nice because it gives you some context and some hints as to where you could enter, and it gives you an idea of where smart money could be potentially positioning themselves. But you also have to adapt for the fact that there's times where the price won't go to your order block, right? And so if it doesn't go to your order block, you're going to be looking for a different model or an entry model, which I could also talk about right after I break this down. So I'll answer that as well. How do I enter from just fair value gaps, liquidity sweeps, internal structure? Okay, so that's another good thing, liquidity sweeps. Honestly, you kind of have to do a mix of a bunch of things, right? One of the first few things is you need to get a bias of where you think price is going. In my previous video that I talked about, there's something called the 3 Ws. I'm going to write those down again. So the 3 Ws, I've actually made a video on this actually, so I'll do it again briefly. So it's basically where was price, where has price been, where is price now, where is price likely to go next. So in order to even take a trade, you have to be able to analyze these 3 questions. I think I might even be wording this wrong, but I think this is right. But you're gonna have to answer the 3 Ws. I can't even talk. You have to answer the 3 Ws, and then you have to do your higher time frame bias. You have to be able to identify your bias, which is essentially do you think price will go up or go down? Or down, right? Swing structure. Now this I don't know if you know what swing structure is. It's not too complicated. It's actually in order to even take a trade, you should actually understand swing structure because it ties into internal structure. So swing structure is the external levels, and then the last part is going to be internal structure. This is going to tie into order blocks and fair value gaps. Oops, I cannot type. All right. So anyways, when you're taking a trade, you should be able to go through all what is this 3, 4, 5, 6 of these things, right? And I'm actually going to talk about all of that right now. So for example, we're going to talk about this trade right here. I'm actually going to make a big box over it so you kind of understand what I'm looking at. We'll make that slightly colored. So we're going to talk about this trade right here, right? And hopefully it kind of answers your question, because in order for me to really answer, you do have to see it in real time or see me apply it. So we're going to go on replay as well. We're going to go right here. Okay. So we can see right here, oops. We can see right here that the market is trending up, right? If you're focusing on this structure right here, it looks like the market is trending up, right? But if you actually zoom out and draw this perfectly, it looks like the price is actually just ranging, right? Now, if you even, so this is where trading is actually, when it comes to technical analysis, it could be confusing, because if you actually draw from over here, you can see that price is just ranging right here, right? You have a low, a high, a low, a high, right? So it's really important how to get your bias, right? So where has price been? Where's price now? Where's price likely to go next? We're going to focus on this. Where has price been? Well, obviously price was all the way down here, right, at 75,000, okay? Where is price now? Price is at 79,000. I'm just going to mark this up really quickly so we can do some analysis. By the way, when you're doing this in real time, it's not going to be this complicated. I have to kind of slow down in order for you to fully get what we're trying to do here. Okay, so we know that price is at 79. We see that price is at 70, or price was at 75. Now, prior to price being at 75, what was the, what direction was the price in? We can clearly see that the price has been trending down for a very long time. So obviously, we're not going to say that we expect price to go down just because it's been going down, because that's not real, that's not enough information, right? Because price could easily, it can go from here to here and then go down, right? It could do a lot of things. So we don't want to just assume it's going to go down from here. We have to answer more questions. We have to do more analysis, right? So where has price been? Price has been trending down. Now let's actually zoom in a bit and look at where price was. Now this is where we have to go in some higher time frames and kind of just analyze. We can see right here, price was inside of a bearish fair value gap, right? I'm going to label this purple, fair value gap, right? So price reacted to this bearish fair value gap. Let's look at the RSI. I'm not sure if you utilize indicators at all, but the RSI is a good one. We can see right here, the RSI, where has price been? Where's price now? Price is overbought right now. Where was price at earlier? Where has price been? Price went to 75. After price reacted after price went to 75, it immediately shot up to a bearish fair value gap around 79, right? So where has price been? It got rejected off a bearish fair value gap, went down, and now price is back at that fair value gap, but it's also overbought. So that's already, in my opinion, that's already a lot of information. We can see that price is, if you know what the indicator is, when price is above, or when the indicator is above 80, that's showing it's overbought. When it's below 8 or below 20, it's showing it's oversold. So to me, this is already a bearish signal, right? Now that's just applying a few concepts, right? Just understanding where price has been and where price was, right? Now if we go on the 4-hour time frame, there's really not much here. I mean, we can also say it looks like price was at a bearish fair value gap on the 4-hour time frame, right? So we already have a lot of red flags, and that already answers our question of our higher time frame bias, right? Of where we are. If we're using the 4-hour, 1 hour, we can say, here, let's actually hold on. So our bias right now, we're bearish. We're looking for a short position, right? That's what we're looking for, right? So we're answering the 3 Ws. So based off where price has been and where price is now, let's actually dive into it a little bit more in the lower time frames. So we now know that price is at 79,000. We can see that the RSI is also overbought on the 15-minute time frame. Oh shit. So price is also overbought on the 15-minute time frame and the 1-hour time frame. So that already, to me, is a bias of I'm not trying to enter long position, because it makes no sense to enter long position at a bearish fair value gap and when the RSI is overbought, right? Especially when the overall trend is still a downtrend, right? Now, with that in mind, we have to also identify liquidity, right? The reason why we should be identifying liquidity is because we have to answer the question, where's price likely to go next? Now, our bias is bearish because we, with all the signals that we have right now, but where is price likely to go next based off that information, knowing that it is a, knowing that price is bearish, where is it going to go next? So this is where we have to analyze the structure in here, right? So if you know anything about market structure and liquidity, I've done this many times in my video. When price is trending up like this, okay, liquidity is here, okay? The same thing if price is trending down, okay, and it's forming lower highs and lower lows, liquidity is going to lie at these highs. Now, the reason why liquidity is here is because this is where the buyers were, right? People were buying here, people were buying here, people were buying here. How do we know that people were buying there? It's because obviously price went up, price went up. So when people are buying there, you know, in the future, they essentially start to place their stop losses here. That's just a psychological thing. That's how people do it. That's because they don't want to lose money. So when price starts to go up, they put their stop losses at break even or at profit, right? So that's where liquidity is. In a ranging market, right? Liquidity is up here and down here, right? So, you know, we're gonna apply this over here. So right here, we can see that the price, okay, so the price obviously went down, and then it started shooting up. It started to form some demand, and then it formed some higher lows. Do you see this? So right here, let me make this a little lighter so you can really see it. Right here, we can see these higher lows right here. Boom. By the way, when I look at this, this is also included. These lows right here also included as liquidity. Okay, these 4 circles. I'm gonna delete that so it's clean, but just to show you, that's pretty much this right here. Okay, so what we can see is that we have liquidity here. This is where people are buying, and so that's where stop losses are at. Now we could also see that we had a liquidity sweep right here. Right? It looks like we could even actually, we would call this our first sign of a break of structure. Okay. So remember, we've already done the 3 questions of where price has been, where price is now, where is price likely to go next. So I'm gonna talk about this in like 1 minute, all right? Just so I can repeat myself over and over, because the more I repeat myself, the easier it is to actually digest what's happening. Okay. So price obviously was trending down on a higher time frame. We essentially bottomed at 75,000. We retraced back up into the 79,000, which happens to be a bearish fair value gap on the 1 hour and 4 hours and the 15-minute time frame. So that's actually a very bearish signal, right? We're consolidating right below this fair value gap, right? So that's bearish. Okay. The RSI on the 1 hour and 15 minutes is overbought right here. 15 is overbought. The 1 hour is overbought. It's showing you even a divergence. Okay. So that's already a bearish sign, which means your bias is, I think price will go down. Right. So now that we know that price will go down, where is price likely to go next? Specifically where? That's what we just did. We just did some analysis on the internal, you know, the structure here. Essentially what we did was we identified where liquidity is, which is at these higher lows right here. And then after that, we're looking at the structure, right? So not only did we kind of tap this fair value gap, but we also established a resistance right here. We established a high. Now this seems like a lot of work, but again, I mean, once you get the hang of this, you're not going to really have to talk. You're not teaching anyone. It just becomes muscle memory. You see it for your eyes, you know, see it very quickly. You don't have to do all this work, right? So this becomes a high, right? So this is what I call, so I'm going to show you. So what we have right here is a high, okay? Actually, I don't like that. Let me see. I'm trying to think of how I should do this. So you have a high, and then what we could see right here is there's a high, low, lower high, and then lower low. Do you see that? And then what we're seeing right here, so I'm going to make this a little brighter. Right? And then afterwards, what we're seeing is price then goes back up, and it looks like what it looks like. What are we doing? It looks like we're actually sweeping this high right here. So you see how like every concept that you mentioned in Discord kind of all ties in together when you're actually putting it together. So what we got was a break of structure, and then people are gonna. So this is the funny part is people confuse liquidity sweep and break of structure. So because the higher time frame is bearish, and we're at a bearish fair value gap, we had a reaction forming this high, right? This low, lower high. We then broke below it, forming a lower low, which then gave us a break of structure. Right here, this is where people get confused. People are going to assume this is a break of structure, and so their assumption is that price is going to go here and then go up there. That's the wrong way to read it. Okay. The reason why is because if you look at it, this is how I'd like to think about it too. Think of this as point A. This is point B. Okay. How far is point A to point B? How much is there more liquidity up here, or is there more liquidity down here? Like you got to think about it. Sometimes you have to. In my opinion, sometimes it's common sense because you have to think about it like. The market is fueled by liquidity, right? It's fueled by stop losses. Liquidity equals stop losses, stop orders, right? And if I, for example, let's say Ray buys here, right? I buy here, Dom shit, I cannot type, buys here. I'm just gonna name some people from the Discord, buys here, okay? So let's say all these people bought here. Do you think smart money wants to go any higher, or do you think it makes more sense for them to go down here to take me out, to take Mag out, and to take Dom out? Like what makes more sense, right? Over here, who really bought here? Nobody bought here. There's actually more liquidity down here than there is up here, okay? The only liquidity that's focused on, like I said over here, if you actually look at what I wrote down, internal structure is order blocks and fair value gaps. So this is the only one that people are focusing on, is this bearish fair value gap. This fair value gaps are also liquidity, okay? So in this case, price is not even trying to break. If price were to break above this fair value gap, it would be a different story. But in this case, this break of structure is not a break of structure. It's actually just a liquidity sweep, okay? And what we would call this is a weak high. Okay, and then price sweeps above this weak high to then fill in this supply zone, right? With the RSI being overbought, and then like I said, like I mentioned, because there's a lot of liquidity down here, it's much more likely that price will go down than it will go up. Okay, and especially with the higher time frames like the 1 hour being overbought, it's likely that we're going to get rejected here than it is we're going to go down here. Or I mean, then it is likely for us to go up here, especially since if you really zoom out, we've been trending down for a while. Okay, another thing, I'm not sure if you guys know this, but when you have price that has a long wick like this and the body is up here. Right, I'm gonna say this again. When you have a wick and a body that's all the way up here, this entire area right here is an imbalance in price. This is an inefficiency. I can't even spell right now. Inefficiency. I already knew I spelled that wrong. But this is an inefficiency right here. So this is another reason why price will likely gravitate down here, because it likes to fill in these inefficiencies. Okay, it wants to rebalance price. So that's another reason why price will likely go down here. Okay, so with that in mind, here, let me see. So now that you understand this, we have this high, this weak high, this liquidity sweep. So now this is the question: how do we take the trade? This is actually the big question. Do we take the trade right now because it's out of red box and it's a liquidity sweep and it's overbought? Nope. This is not where the trade is taking place. This is just giving you an idea that this is likely where price. This is an idea that if price starts to react negatively here, if it starts to respect this box, then we could potentially see a trade opportunity here. Okay. So obviously you'd have to watch what happens next. Now in this case, watch this. Okay. So what happens is you end up dropping. You have this impulsive candle, this displacement candle, right? And then you actually leave an order block here. I don't know if you see this. You have an order block. Let's make this like a different color. So you have an order block here, and then not to mention you have this bearish fair value gap right here. So this is where the trade takes place. Okay. Now, not necessarily the trade takes place here, because you do have to watch the reaction. But given all the analysis that we've done, that there's a lot of liquidity here, and that all we did was give us a break of structure with the liquidity sweep above this weak high, because a lot of people are going to confuse this liquidity sweep for break of structure when the break of structure occurred down here. Okay, and this retracement up here was just a liquidity sweep. Okay, so afterwards, price then rejects from this supply zone, right, or this order block, goes back down, and now it gives you an opportunity to take a trade. So what I like to do here personally is I like to draw a retracement from this high to this low, assuming this is the low. We can see right here, you now have this 0.5, 0.75, which then gives you a premium. Now, of course, this is going to depend if you're even trading, if you're going to be using Fibonacci, right? If you're not using Fibonacci, then you don't have to use this. But what you do have inside this premium is a fair value gap, and right above it is an order block. So I don't know if I said this in the beginning, but a high quality order block is followed by a fair value gap. Okay, again, a high quality order block is followed by a fair value gap. So when you have both of them, that's an even higher quality order block to focus on. Okay, so when price does come here, right, then you could potentially look for a reaction here and then take the trade. And then remember, because we've done all the markups already, we anticipate price will take out this guy. So remember, because it wants to take me out as well. Okay, so this is going to be the liquidity that we're going to focus on. So if we were to take this trade at this premium, stop loss, okay, stop loss is very important here. We are not placing our stop loss at this high. It's very tight. We are going to either place our stop loss above this high right here or above the fair value gap. But even then, the fair value gap is way too high. So I would actually say have it above this high right here. So it's this high right here. We're going to name the strong high just for the video. Now, the reason it's a strong high is because it led into a break of structure. Okay, so we don't want price to go above this high, because if it does, that basically neglects the whole point of this break of structure, and it's not of, you know, everything we, or essentially our analysis would have been wrong if price were to go up here. Okay, so we're going to put our stop loss above this high, right? And then we're going to take profits below these lows right here. Below these lows right here. Now, the reason why is because, like I said, you have a strong high, lower high, weak high. Okay, this is basically your lower high. And then you have this, because you know it's a downtrend, right? Boom, 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 boom. You expect another lower low to be formed. Let me draw this better. Okay, you expect another lower low to be formed. And because there's a lot of liquidity here and here and here, we expect price to come down to these levels down here. Okay, and because you have this inefficiency, price will seek to rebalance price. So it's going to come back down into this area again. And of course, if you're super bearish and you have a higher time for bias that price will go even lower, then obviously you can target this external liquidity. And from there, you know, obviously that would then continue on with the trade with price making lower lows and lower highs, right? So like I said, we're going to play this just so I can show you, break it down. For example, right here, price then goes into our premium. Okay, now taking this trade, you can already see the reaction right here. Look at the reaction. Price forms like a double top right here. It has trouble even going above it. So in this case, you don't even need to rely on the indicator. You can rely on the price action itself, because you've already done all the context and analysis. Okay, so this premium and fair value gap is order block. You can take this trade knowing that price will come back down here. Now, and like I said, if you're going to take this trade, you're going to take the trade somewhere here. Well, as it's falling down, you're going to take the trade and you're going to place your stop loss right above this high. Because if price, listen, if price were to go up here, it essentially, like I said, I've said this many times, it neglects the whole trade itself. The idea of taking the short was wrong, and that's where your analysis should have, you'd have to kind of rethink your whole analysis. But if your analysis is right, then this should continue lower, okay? Because then again, like I said, it's going to want to take out all this liquidity here, essentially where we were buying, okay? In this case right here, we can see that it actually takes out these people right here, right? Like I was saying, liquidity. You have to be able to answer the 3 W's, okay? Where has price been? Where's price now? Where's price likely to go next, right? I really hope, I think this video is pretty long. I really hope this actually makes sense. But like I said, the trades that are taken, this would have been the highest quality trade that could have been taken, because then you would have captured this entire move down. And this would have been a 2-3% move, depending on the leverage you're taking. That's roughly a 50 to 100+% move, right? In this case, there's no longer a trade valid here. Taking a short is risky, so you'd have to wait for the next setup to form, right? And it looks like right here, you're continuing to get this break of structure, right? So obviously just something to kind of watch as price continues lower. even right here, you get this little breakup structure. Okay, so use a Fibonacci retracement. But aside from that, I'm trying to think of what else I didn't answer. Okay, continuation and internal structure. So this is also just as important. So you see how I'm trying to think of how to do this. So this right here, pretty much this entire move down. And I'm trying to think of how I should answer this because it's okay. So a lot of people oftentimes when they're trading, they're very focused on these highs, these lows, these highs. But when it comes to focusing on internal structure in trading, you actually want to focus more on internal structure than external structure, or I guess swing structure. So I'm going to kind of show you what I'm talking about. I got to draw this out a little bit. So a lot of people, let's say price forms a high right here, right? And then it starts to break down. It starts to go into this downtrend. A lot of people like to focus on this high and this low whenever they're doing analysis. They're like, oh, my box is going to be here. My box, is going to be right here. But when it comes to trading, the way you should actually approach trading is through the internal structure, because that's actually how you're going to get your entries. And what I mean by that is these small moves right here, this circle right here is actually where the trade is taking place. So when you're actually looking for entries, you shouldn't be so focused on this entire move right here, because this is just going to be your point A to point B, okay? And when you're trying to trade the retracement back up, you have to be able to analyze this information right here to kind of give you the entry, okay? So, and that's why I like using the fib, because then again, like I said, this is one move. This is your low, this is your high low, and then you have that impulsive candle up. And so a lot of people, like I said, they're so focused on, like, for example, they're so focused on these moves right here that they're not focused on the moves right here, because the trade, like I said, it takes place during these moves right here. Okay, let me see if I can try to draw that one more time. So like I said, when people are trading, they're so focused on the big move, like this entire move down, but the trades that are actually taking place are inside these boxes right here that I'm drawing. So if you actually want to take a trade, you have to be able to take the short here, stop loss above this high, and then obviously target to form on their lower low. Okay, that's going to be your internal structure. This entire structure though is going to be your swing structure, which is focusing on the entire move down, right? So for example, like for example right here, you have this swing structure right here where price forms a high. Okay, this is a high, and then right here this is a low. But the trade is not taking place at this low or at this high. The trade is taking place right here at this premium, at this order block and fair value gap. So this is going to be your internal structure, and that's what you're going to be focusing on to take your entry. So you have to be able to differentiate between the swing structure and the internal structure, and that's where you actually want to focus on the order blocks and fair value gaps. I would even add Fibonacci retracement, just because, like I said, it's one of my favorite tools to use, but that's really up to you, right? I'm trying to see what else. Oh yeah, I forgot. There's another gap that also forms here. Let me just show it to you, where this order block. So right here, we can see right here that the price has a bunch of impulsive candles to the downside, right? You can see that obviously sellers are in control of price, and then immediately, as soon as we swept this low, a lot of people started buying here, and then you have this big candle, right? So when you look at this big candle, it actually leaves a fair value gap right here, right? Leaves a small gap, and then it leaves this order block. So in my opinion, this is going to be the highest quality trade you could have taken recently, especially as a day trader. So if you're going to take this trade, like I said, you obviously take it. Wait, actually, before I even talk about that, take an entry. When price, so price forms a low, a high, okay? So when price starts to retrace back down, and you're talking about that order block, you want to see price tap it about 2 times, okay? 2 to 3 times. 3 times, more than 3 times is a bit too much. The first 2 times you want to start seeing a reaction. Okay, so right here, you can see there's a reaction, and then here you have intention. So listen, you have reaction and then there's intention. The reaction is obviously price reacting to that order block where, you start to see wicks, you start to see people stepping in, but that's not, so just because you have a reaction does not mean you have an entry. An entry is going to follow once you have intentional price action, meaning this is a bullish order block, right? So the context behind this is that price has been trending down since, from point A to point B, right? So this is point B, okay? So point A to point B, we've been in a downtrend. That's that's where we were. Where we're at now is that price establishes a high. We're then retracing into this order block, right? So once you retrace into this order block, this is a bullish order block, which means you have to see bullish price action occur at this bullish order block, right? And so in that case, you don't want to just see a reaction of price, you don't want to just see wicks, but you want to start to see some bullish candlesticks. You want to see some higher lows. You want to see some impulsive candles, right? So in this case, what do we have here? We start to see these higher lows form right here. I don't know if you see this. So these higher lows are indicative of an uptrend. Remember, higher. So this is actually internal structure. That's a funny part. Internal structure. We're seeing higher lows, right? And a lot of people, like I said, a lot of people are so fixated on like this this low, this high, that they forget that there's a trade right here. The real trade, if you're really good trader, the trade takes place in this box right here. Okay, let's change this into a green box. So if you're really, really good, the trade takes place inside the internal structure. So maybe I should write this down. Internal structure is where trades are taking place. Okay, let me look at this. Let me write that. What else? I think that's pretty much it. So higher time from bias, where do you think price will go? And this is going to depend on how, the context of price. And I would say the higher time from bias is going to align with the 3 Ws. Okay, so these go hand to hand. The swing structure, like I said, is going to come down to the highs and lows, the swing highs and swing lows, and then the actual trade takes place inside of that swing structure, right? So in this case, you have to be able to identify it pretty early. So right here, internal structure, we're seeing higher lows on the wicks, okay, and we're seeing bullish candlesticks at the order block. So this would have been a valid order block to enter a trade, right? So when you take this long position, it doesn't matter if you took it all the way down here at the actual order block or if you take it over here. Stop loss is also important because this is a bullish order block, okay? We want to set our stop loss below this low, because if price wants to go any higher, do you think it wants to disrespect this low, right? Price wants to make low and then higher low, okay, as a swing. Okay, this is a swing. Okay, so when you think about it, when you join the path tool, this is a low, high, and a low, and then obviously we're just going up from here. But when you're actually looking at it deeply on a lower time frame, the trade that we're actually focusing on is this, pretty much this part right here. Okay, so this orange part is where the trade is taking place, and from there the stop loss would be right below this low where the displacement happened, and then you would be taking profits. Depending on how you do your analysis, you're gonna take profits up here or even up here. It just depends. Okay, I'm not gonna go through that. I think I've already gone through so much over here, but like I said, I hope that helps. I think this is a lot of information, to be honest, in one video. So I might have to make more videos on this, or I might have to just make separate videos on each topic, because it is a lot to put in all into into one. So we'll see. Let me know. All right.